The market for OpenDoor Technologies Inc. is closed for the day, with the stock finishing the last trading session on Monday, December 1st, 2025, at a closing price of $7.13. This represented a substantial down move of 27 cents or 3.65% from its previous close. This price action already sets up a fascinating tension because the general expectation among the retail crowd, especially after the dramatic run-up earlier this year, is that OpenDoor is a comeback story, the ultimate play on a real estate market thaw. The reality, however, is that this recent daily dip, following a much more volatile period, suggests that the market is struggling to reconcile the long-term, cyclical narrative of a housing recovery with the immediate, structural challenges the iBuying model faces, particularly in an environment of stubbornly elevated interest rates. This is the crucial point of separation we need to explore. The stock is trading on hope for macro relief, but its price is being dictated by the very specific capital-intensive risks of its business model right now. The expectation is a steady climb back to its highs. The reality is a choppy, volatile consolidation phase where bears are still very much in control of the daily and weekly flow. The stock's recent movement has been characterized by sharp swings indicative of a battleground stock. Looking at the weekly chart, the daily volume of 73.62 million shares in the last session, while below its average of 132.66 million, is still significant and highlights continued high interest. The dip comes after a period of intense institutional activity that saw firms like Jane Street Group, Renaissance Technologies, and American Century Companies dramatically increase their long positions in the third quarter. This institutional conviction provides a counter-narrative to the selling pressure, suggesting that professional investors are positioning for the long term, possibly anticipating that OpenDoor's recent management changes and strategic shift towards a more profitable, capital-light model will eventually bear fruit. This disparity, retail enthusiasm tempered by volatile price action, juxtaposed against quiet institutional accumulation, is where the real opportunity and the real risk lies for the individual investor. Let's discuss the short side of the equation, which is not just an addendum to the OpenDoor story, but a central, driving force in its volatility. Short interest in OpenDoor is remarkably high, standing at approximately 127.36 million shares as of the most recent settlement date, representing over 16% of the free float. The days-to-cover ratio, while variable, is hovering around 1.28 days, which is not an immediate explosive short squeeze signal, but it shows a meaningful amount of shorting activity that can create significant upward pressure on any sudden positive news. The short thesis is straightforward and powerful. OpenDoor's core iBuying business is essentially a proprietary trading desk for real estate, highly sensitive to inventory carrying costs and the speed of home sales. In a high-interest rate environment, their cost of capital skyrockets, and the risk of holding devaluing inventory increases, leading to a structural and persistent unprofitability, which is reflected in their negative P/E ratio. We've seen notable firms like Citigroup and Keefe, Bruyère & Woods maintain or issue sell and underperform ratings with very low price targets, which serves as a powerful anchor against the price. Their research often highlights the continued struggle for gross margin profitability and the immense scale needed to truly offset their operational expenses. Actionable insight for the retail investor here is to monitor the short borrow fee rate, which has remained relatively low at around 0.37 to 0.42% annually in recent weeks. A spiking borrow rate would indicate that the shorts are feeling pressure or that the supply of shares available to lend is drying up, a precursor to a potential short squeeze. Conversely, if the short interest percentage remains elevated while the price continues to consolidate lower, it suggests the market is validating the short thesis, and chasing the stock on momentum alone would be incredibly risky. A key signal to look for in the next reporting cycle is whether OpenDoor's internal algorithms are getting better at pricing. Are they reducing the size of their gross margin losses per transaction, which is the necessary step before they can ever become net profitable? The social media chatter, particularly on platforms like Reddit, is filled with calls for a coordinated short squeeze, which is understandable given the high short interest, but investors must remember that coordinated pushes against professional short sellers often end badly. The size and complexity of this company means the short thesis is fundamentally about structural business risk, not just sentiment. The company's business is centered on being a digital platform for residential real estate, primarily operating through its instant buying model or iBuying. OpenDoor buys homes directly from sellers, makes necessary light repairs, and then resells them all in a matter of days or weeks. This provides sellers with speed and certainty, eliminating the traditional friction of showings and lengthy closings. Their value proposition hinges on their proprietary pricing algorithms, which they claim can accurately forecast home values and renovation costs at scale, allowing them to turn over homes for a profit. Historically, their performance was fueled by a hyperactive, low-interest rate housing market, which masked the true costs of this capital-intensive model. The recent shift in their strategy, which they call OpenDoor 2.0, focuses on becoming more of a marketplace facilitator alongside their core iBuying, emphasizing software and leveraging partnerships to reduce the immense balance sheet risk associated with holding large home inventory. This strategic pivot is the central catalyst the bulls are betting on. The November special dividend of tradable warrants, with exercise prices at $9, $13, and $17, was a brilliant move from a shareholder alignment and capital management perspective. It essentially gives existing shareholders an option to participate in a future high valuation, incentivizing them to hold. It's a confidence play by management that subtly says, "We believe the price will be significantly higher in the coming year." The future outlook for OpenDoor is a complex calculus that balances macroeconomic forces against company-specific execution. On one hand, any definitive signal from the Federal Reserve that interest rates have peaked or are even set to decline provides a massive tailwind. Lower mortgage rates fundamentally improve the economics of their business, reducing their cost of capital and increasing the demand for the homes they sell, accelerating inventory turnover and reducing holding risk. If the housing market stabilizes and volume returns, OpenDoor is arguably positioned to capture a large share of that volume, given their established footprint. On the other hand, the company must prove that OpenDoor 2.0 can actually deliver sustained positive adjusted EBITDA independent of macro conditions. They need to demonstrate that their algorithms can consistently buy and sell homes with sufficient gross margin even in cooler markets. The question remains, is the iBuying model inherently profitable, or is it merely a feature of a specific, overheated housing cycle? The skepticism among a significant portion of Wall Street, as reflected in the low median analyst price target of around $1.88, is that the fundamental unit economics are still a major hurdle. They see the model as a volume-driven play that will chew through cash until market conditions are perfect, and perfect conditions are far from certain. The tension between expectation and reality here is stark. The expectation, heavily broadcasted in the retail community, is that OpenDoor is a distressed asset that has hit its bottom and is now positioned for a multi-bagger return as the housing market recovers. The reality is that the company is undertaking a fundamental, difficult pivot of its business model while under siege by short sellers and navigating the most challenging macro environment in its history. The warrant issuance and executive changes, which include the return of co-founders to the board, are real, tangible signs of management conviction and strategic focus. The reality exceeds the expectation of just a passive wait-and-see approach. However, the consistent selling volume and pressure indicate that the market is waiting for proof in the form of consistently improved gross margins and reduced inventory risk on the balance sheet. OPENDOOR needs to show it can thrive, not just survive, the current real estate climate. The short-selling angle remains fascinating and crucial to watch. If the company delivers an earnings report where their inventory days decline significantly and their contribution margin improves substantially, the high short interest becomes a massive coiled spring. However, shorts are not irrational. They are capitalizing on the predictable difficulty of profiting from the spread between a home's purchase and sale price while paying high holding costs. We must look at which institutional short firms, often quiet in their public commentary but aggressive in their positioning, maintain their large put options or direct short positions in the coming months. Their motives are generally to profit from a return to what they see as the intrinsic, lower value of the business given its current cost structure.